In today's video, I'm going to explain what a Roth conversion is, when it's a good time to consider doing one, and how to actually execute it. I'm Raul Shah. I'm the CEO of DocShah Financial. We are a wealth management practice that helps retirees and pre-retirees pay way less in tax than they otherwise need to. We use a lot of advanced tax planning strategies with clients, and the slides that you're seeing are directly from the retirement planning course that I teach at Johns Hopkins University, which is also my alma mater. So let's jump in to Roth conversions.
Okay, let's go.
So the first thing you're probably wondering is, why is there an RMD calculation as the first slide? Well, I'm going to actually quantify the benefits of a Roth conversion for you. And in order to do so, I need to have a control group, right? Something to actually compare the benefits of that Roth conversion to. So I've just drummed up this example, and it's going to serve as our starting point. So you can see we've got a gentleman named Bill, and Bill is 73 years old. Now, because he's 73, Bill has to take what's called an RMD, required minimum distribution. It's essentially the IRS force feeding you money from your tax deferred retirement accounts so that they can ultimately collect their tax revenue. Now, an RMD is actually calculated very simply. Now, in this slide that you'll see, I've drummed up a couple numbers. The first one is $2 million. We're going to assume that that is Bill's portfolio balance in his traditional IRA. The IRS has a table that they publish, and that's where I got that number from. That is the amount he has to pull out of his traditional IRA at age 73. Technically, the first RMD you can waive until the next year, but we're not going to get that complicated. He's going to pull that out at age 73, and he's going to pay tax on the amount that he withdraws at his ordinary income rate. So that's going to be our starting point. Just remember that, right? The first year's RMD is $75,472. And now let's talk about Roth conversions. Roth conversions are simply what they sound like. You are converting money to your Roth IRA. Money that you are converting to your Roth IRA, pre-tax money. So for example, if I have $20,000 in my traditional IRA of pre-tax money, and I move it to my Roth IRA, or I convert $20,000, that $20,000 is now included in my taxable income for the year. So I will pay tax on that conversion at my ordinary income rate. But now everything in that Roth IRA is going to grow tax-free. The idea is that if you strategically do conversions, and remember, conversions, we're just converting pre-tax to after-tax money. That's why it's called a Roth conversion. If we do these strategically in low-income years, for example, after you retire while you're living off of Social Security and before RMDs kick in, you actually have an opportunity to save tens of thousands of dollars, if not hundreds of thousands of dollars in lifetime taxes, depending on your portfolio size. So let's take a look at Roth conversions in action. And I'm going to read off the slides a little bit because this is really important information. You'll notice on the left here, we've got pros of a Roth conversions, and we have 4 of them. The first is that you are locking in today's tax rate. When you do a conversion, you are voluntarily choosing to pay tax at your current tax rate. And if it's low, you're going to pay a low tax rate. You wouldn't want to do this when your tax rate is high, because then you are just voluntarily choosing to pay high tax on your conversion. Don't want to do Roth conversions when you're in a high tax bracket. The second pro is that Roth IRAs have no RMDs. This is actually a great legacy planning tool when you're considering how to maximize giving your heirs the most money after tax as possible. The other advantage of the Roth conversion is that all of the future growth is tax-free. So once you convert that money to a Roth IRA, if you want to buy growth stocks and those growth stocks go up, 2 or 3 times, you don't pay any tax on any of those gains. So that's another wonderful part of having more funds in your Roth IRA. And the fourth, and this is why I started with RMDs, is when you do that conversion, right? When you move pre-tax money in your traditional IRA to your Roth IRA, you actually now have a smaller balance in your traditional IRA. So going back to that example before, if Bill did a Roth conversion years before 73, he would not have $2 million in his traditional IRA. He would have less money, which means his RMD would be less, which means his tax would be less. And we're going to actually quantify that in just a second, but that's a huge advantage of a Roth conversion. Now, Roth conversions are not a panacea or a cure-all. They have to be done strategically. There are cons to it. So the first one is you will owe income tax on the amount that you are converting. So you need to be able to fund that payment with outside money. If you withhold taxes from the actual conversion. So if I'm converting 20,000, but I keep 4,000 out of it for taxes, that negates a lot of the benefit because that 4,000 would have been growing and compounding in your Roth IRA is now no longer in that account and it went out the door to taxes. So that adds a lot of complexity to Roth conversions and really just diminishes the effect and the benefit of them. So we need outside money to fund that Roth conversion ideally. The Roth conversion increases your income, which means that more of your Social Security could become taxable. If your income crosses a certain threshold, you could be subject to IRMA surcharges, which is an additional premium on Medicare Part B and Part D. And it's irrevocable, so you can't undo it. So there are cons to it. If you decide to change your mind or something happens where you actually can't fund the tax anymore with outside money because something came up in your life, well, you can't take that Roth conversion back. So there are cons to doing a Roth conversion that need to be weighed against the pros of doing one. The reality is Roth conversions are best for three types of people. They are best for people who A, can afford to do a Roth conversion, who have the outside capital to fund the tax. They're best for people who are in a low tax bracket today that expect to be in a higher tax bracket in the future. And they're best for people who really want to maximize their legacy and the amount of inheritance that they pass on to their heirs. Now let's walk through a Roth conversion example. And I know there's a lot of numbers and it's chaotic on the screen. Don't worry, I will walk you through every section and it will be easy to understand. Now let's take a look at that first box here on the left. We can see here that there's no RMDs because they are not 73, and the only part of their Social Security that's taxable is actually $2,000. You don't need to worry about how Social Security taxes are calculated for the purpose of this video. Just know that in this particular example, if their income is $72,000, the way to actually calculate how much of their Social Security is taxable is sort of a separate calculation that I just did in the background, so I didn't clutter up the screen too much. But essentially, only $2,000 of their Social Security is going to be included in their taxable income for this year. Now, for their deductions, they have $32,200 in the standard deduction for those married filing jointly in 2026. And there's also a range of new senior deductions that apply for 2026 for those over 65 years old. And those amount to $15,300, as you can see. So the total deductions are $47,500. So now let's go to that box on the right. In order to calculate our total taxable income, we're going to take our adjusted gross income, which is just $2,000. That's all of our Social Security that is subject to ordinary income tax. We're going to take out our deductions, which is $47,500, right? Well exceeding the amount of our income. We now have a total taxable income of $0. Well, what does that mean? So that means we have an opportunity to do a Roth conversion. Remember, we want to do Roth conversions at low tax brackets. The 10% tax bracket is a low tax bracket. It's the lowest one at the federal level. So let's figure out how much can Bill and Marianne convert from their traditional IRA to their Roth IRA and only pay 10% in tax. We call that filling up the bracket. We can calculate that. Let's look at that lower middle box now. We can see that the entire 10% tax bracket ranges from $0 to $24,800. So we're going to use that as line item 1. We're then going to add in our total deductions of $47,500 and subtract out the income of $2,000 that's already filling up some of this bracket that we have. And you can see here that the result is that we can add $70,300 to our taxable income this year and stay beneath the 10% tax bracket. Meaning that if we do a Roth conversion of $70,300, we're only going to pay 10% tax on that conversion. And if you think about it, most retirees, when they are going through RMDs, are likely going to pay more in income tax. Maybe 12% is your marginal tax bracket or 22% is your marginal tax bracket. If your marginal tax rate in retirement will be 22% and you're converting funds now at 10%, well, you just save 12% in tax on every single dollar that you just converted, right? The difference between your future tax rate and your current tax rate times the amount of the conversion. So now let's actually take a look at the next slide, which is the actual numbers and taxes behind what we just executed. Remember, in this example, we're filling up that 10% tax bracket. So if we look here on the left, we are going to pay 10% in tax on $70,300, which is $7,030 in taxes owed on that Roth conversion. Very simple. We do that Roth conversion, we're going to owe tax now. Now, if you look here at the middle slide, that Roth conversion, though, lowers the amount, the account balance in that traditional IRA by $70,300. Remember, Bill had $2 million in his portfolio, but now because we moved $70,300 out, he's got a lower balance. Wait a minute. If he has a lower balance, that means when he is 73 and he takes his first RMD, it's going to be lower than it otherwise would. And if we do the math, his new RMD will be $72,819 as opposed to $75,472. So the Roth conversion lowers that RMD in year one at age 73 by $2,653. And in fact, if we did the math on the taxes, the total tax paid before the Roth conversion was about 10 grand. And with the Roth conversion, the total tax paid is about $9,800. So Bill and Mary Ann will save $331 in taxes in the first year of their retirement just by doing this Roth conversion. Because remember, the tax owed on $75,472 is going to be higher, right? It's about $10,205 versus the tax rate on $72,819, which is going to be $9,874, right? That makes sense. If the traditional IRA balance is lower in the future, well, your RMD is lower and therefore your tax is lower. And the tax saving by doing this Roth conversion is $331, right? That is the difference in this example. Now you're probably sitting there and wondering, wait a minute, why would I pay $7,000 in tax today just to save $331 6 years down the line? Well, the tax savings are just getting started and they're only going to get better and compound over time. Let's take a look at that now. Okay, there's a ton of stuff on this slide, I know, but don't worry. I'm going to walk you through everything in slow detail. So we're going to start here on the left. Our starting point for the traditional IRA is now $1.93 million because Bill and Mary did $70,300 in a Roth conversion, lowering it from the original $2 million balance to $1.93 million. Therefore, all of the future RMDs are going to be lower and lower. And you can see that here if you look at the post-Roth conversion numbers compared to the pre-Roth conversion numbers in any given year. So every year I can actually go and I can calculate the tax savings. In the first year, like I said, is $331. In the next year, it's $337. $357 in the next year, so on and so forth, all the way to age 94, where the tax saving is $1,600. That is the difference in the taxes when we are comparing an RMD pre-Roth conversion versus post-Roth conversion. And if we add up all of the tax savings for this entire duration, in the bottom right corner, you'll see that Bill and Mary will have saved $22,259 doing that one Roth conversion. So now let's actually quantify the overall tax savings from this Roth conversion. Well, remember, in year one, Bill and Mary Ann saved $331 in taxes. And if we add up all of the years of tax savings due to the lower RMDs from the Roth conversion, the total tax savings is $22,259. And there's one more really important nuance here, and it's that the money that you converted to your Roth IRA is actually growing still while you're waiting for that first RMD. And the funds in your Roth IRA, all of that growth are tax-free. Had that $70,000 been in your traditional IRA, you would have been taxed on that growth. So we have to include the fact that this growth is tax-free. So there is a tax saving from there as well. If we just take some basic numbers, like you were making 6% in your Roth IRA and you were in a 12% tax bracket, you're actually saving $5,000 in tax on the gain in your Roth IRA, which would have otherwise had to have been paid if it was in your traditional IRA. So if we go to the middle slide now, we can calculate our tax savings from the Roth conversion. We have $22,259 from lower RMDs. We have about $5,000 from having our gains not being taxed in our Roth that would have otherwise been taxed in our traditional IRA. And so the total tax saving is $27,269. But remember, we also paid $7,030 to actually do that Roth conversion years ago. So the total lifetime taxes saved in this example is $20,239. And if you were to do this strategically, not just in 1 year, but multiple years, you can see that the tax savings really start to add up. If you want to learn how to potentially save a similar amount or even more in taxes using Roth conversions or any one of our other advanced tax planning strategies, shoot me an email at Raul@DocShah Financial. I'd love to hear from you and your personal situation and if I can help you, just like I've helped many other clients in the same situation as you. And I'll see you in the next one.